There is no new IRS limit on how much money you can keep in your checking account. None. But three real changes to bank and tax reporting did take effect in 2026, and one of them means less paperwork for you, not more. By the end of this video, you'll know exactly where this checking account limit rumor came from, what the IRS actually changed this year under a law called the One Big Beautiful Bill, and whether any of it touches your money. Every figure in this video is confirmed directly against IRS.gov. Let's start with what's real and what's been real for over 50 years. Banks have always been required to report cash deposits or withdrawals of $10,000 or more. That's not new, and it's not quiet. It's been federal law since 1970 under something called the Bank Secrecy Act. If you deposit $10,000 in cash in one transaction or in a string of related transactions, your bank has to file a report with the federal government. This is about large cash movement, not your account balance. Having $50,000 sitting in your checking account has never triggered anything. Moving $10,000 in cash in or out does. Now, here's where the rumor actually comes from. Back in 2021, the Treasury Department floated a much bigger idea, having banks report on every account with just $600 of total money flowing in or out over a year. That number caused real panic, and understandably so, but that proposal got walked back almost immediately to a $10,000 threshold, and then it was dropped entirely. It never became law. If you've seen posts warning about a $600 IRS bankroll going into effect this year, that's a 5-year-old rumor still circulating. It's dead. It was never resurrected. What did actually happen in 2026 is different, and it has nothing to do with your bank balance. It's about tax forms. There's a form called the 1099-K, which you receive if you're paid through apps like Venmo, PayPal, or Cash App for goods or services. For a while, the threshold for getting one of those forms had dropped all the way to $600 thanks to a 2021 law. That meant people selling a used couch or splitting a vacation rental payment were getting tax paperwork they never used to get. In 2026, the IRS confirmed that threshold reverted back to $20,000, and it also brought back a 200 transaction requirement that had been dropped. So, unless you're processing more than $20,000 in more than 200 separate payments through an app in a year, you won't get a 1099-K for that income. There's a second change, and it affects a different form. If you do freelance or contract work, say, some part-time consulting and retirement businesses that pay you have historically had to send you a Form 1099 NEC once your payments cross $600 in a year. That $600 number had been frozen since the 1950s. Starting with payments made in 2026, that threshold jumped to $2,000, and it will now adjust for inflation every year going forward. Let's put real numbers on this. Say you're retired and doing some part-time bookkeeping work on the side, and one client pays you $1,500 for the year through Venmo. Under the old rules, you might have received both a 1099-K from Venmo and a 1099 NEC from the client for that same income. Under the 2026 rules, you get neither because $1,500 is under both the $2,000 threshold for the 1099 NEC and nowhere close to the $20,000 threshold for the 1099-K. Less paperwork, not more scrutiny. Now take a different retiree who deposits $10,000 in cash after selling an old car. That deposit still gets reported by the bank exactly the same as it would have 10 years ago or 30 years ago. That rule hasn't moved. It's not part of the 2026 changes at all, and it's not going anywhere. Here's the part that trips people up. Reporting is not the same as taxing. If a payment gets reported to the IRS, whether through a 1099 form or a bank filing, that doesn't automatically mean you owe more money, and it doesn't mean you did anything wrong. It just means the transaction is on record somewhere. And there's one thing that genuinely will get you in trouble: intentionally breaking up cash deposits into smaller amounts specifically to stay under that $10,000 threshold. That's called structuring, and it's illegal on its own, completely separate from whether the underlying money is legitimate. Don't do that to avoid a reporting rule that was never a real problem for you in the first place. Also worth knowing, even if you don't get a 1099 form because you're under the new $2,000 or $20,000 thresholds, the income is still taxable. You're still required to report it on your own return. The form just isn't automatically generated for you anymore. If you do part-time or freelance work in retirement, keep your own running total of what each client or platform pays you across the year, separate from whatever forms show up in January. Don't rely on the forms alone. With the new higher thresholds, you may get fewer of them than before, and the income is still yours to report. If you're depositing a large sum of cash from something like a home sale, an inheritance payout, or downsizing, just deposit it normally in one transaction if that's how it naturally happens. Splitting it into smaller chunks to stay under the radar is the one move on this list that can actually create a real legal problem, even when the money is completely clean. If you've seen this $600 bank rule rumor floating around online and want a specific version of it fact checked, drop it in the comments and I'll dig into it in a future video.